Hargreaves Lansdown made a recent announcement that's got me very excited.
Yes, yes, yes.
This has the potential to save me thousands of pounds over the full term of my investments, and not only that, but bring my overall target for my savings pot forward by quite a few years. And if you regularly buy shares or reinvest your income with Hargreaves Lansdown, then this will be big news for you too. So what's led to this news? Well, the savings market has been really heating up over this last year, which is great for savers. This competition has led to some decent rates on savings accounts from most lenders, but if you choose to invest into a stocks and shares ISA instead, then there are no guaranteed rates like you get with a traditional savings account. Instead, Hargreaves Lansdown are tempting customers to use them by cutting some of their fees. HL have had notoriously high fees for a while. If you've looked into the best stocks and shares ISA providers, this will likely be something you've seen mentioned as a negative. I personally can cope with the high fees, as I think their clear dashboard and customer service negate this. I like that I can see what I hold clearly and I can research future purchases easily. I also like that they're a big name, as this gives me some security in a turbulent world. You may feel differently and prefer other providers, and that's absolutely fine. I'd never push anything on you guys. If you are curious about how much I pay in fees on my investments though, I do make a monthly portfolio update and show what I've paid for the privilege of investing each month with Hargreaves Lansdown. So if you want to check that out, then go for it. So why am I so excited about this news and what exactly have they cut? If you watched my previous account managing video, we looked at the fees for regular investing. Basically, if you want to avoid the roughly £12 charge to buy shares, you can set up a monthly instruction instead that charge £1.50 per instruction. Now this way of buying shares has its negatives and positives. If you choose the regular monthly instruction route, your shares will be bought on the 10th of each month, so you are at the mercy of the market. If you're investing small amounts each month, or are cost averaging your way in, then this can be okay, but a lot can happen to a share price in a month, and if you're buying large amounts you could easily lose the £10.50 difference in a sharp rise in the share price. With the latest news, Hargreaves Lansdown have now got rid of the £1.50 monthly fee for regular investing. So now there's no charge to buy into FTSE 350 shares, eligible investment trusts or ETFs. This may not seem like a big deal, but if you look at the bigger picture, that £1.50 saving each month, if added to your portfolio month after month, could really make a difference. This is especially the case if the shares you purchase also pay dividends, because the second piece of news regarding their fees is they've now scrapped the charge to reinvest your dividends. It's worth noting as well that there's still no charge to buy into funds or to reinvest the income from them either. The effects of these two charges being scrapped can have a massive impact on your investments over the longer term, and as I know you lot are smart investors, I know you're looking at the longer term. If, like me, you're aiming for an ideal end goal amount to have in your savings pot and you invest regularly into your Hargreaves Lansdown stocks and shares ISA, then this has potentially just given you a massive head start on the way to your end goal and potentially saved you thousands in fees over the long run. I've heard a lot of people say the first 100,000 on your investing journey is the hardest. Some of the reasons for this are because unless you hold some stock with likely unsustainable dividend yields, you won't be seeing mega returns in the way of dividends. So you'll be likely having to cover your fees from your own pocket, and on top of that some fees are capped, like the old dividend reinvestment fee of 1% up to a maximum of £10. So over the long run, your real term reinvestment fee will be going down as that £10 is deducted from a larger and larger amount. As long as the dividend yields stay roughly the same, then your income will grow in a similar way to compounding interest. The more that gets reinvested, the more stock you hold for future dividend payouts, and so it goes, on and on, building larger and larger amounts. The scrapping of fees speeds this progress up massively. I've been saying for a while now that I want to diversify my portfolio and buy more value shares, but also grow my dividend returns. So this news to me couldn't really be any better. Let me know below what you think of it though, and if it will be changing the way you invest. Has this made you look a bit closer at regular investing, or has it made you pay more attention to some of those juicy dividend yields that are floating about currently? That's it for today. Don't forget to leave a like and subscribe for future content. Stay safe out there. Peace.